Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, registered investment advisors, family offices, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion, the CEO and founder of our marketing partner, Flying V Group. Robb, how are you?
Doing great, Gary. Happy Monday.
Yes,
As always, happy to be here for the five things.
of course. How are so you're traveling today. This time I get to ask you the question, where in the world are you?
Well, I feel like I don't go very far, unlike you, but yeah, I'm in Northern California this week, so Sacramento, Folsom area, with the wife's parents. So I watched Super Bowl yesterday, heading back to Southern California this morning so I can
Did
get
you
a haircut.
did you yes, that's we're looking forward to that. Everyone tune in next week to see Robb's haircut.
Yes, I
Uh,
promise.
right. It's going to be our new channel is going to be finance and styling.
We might be in trouble if we start blurring those lines. So
I know,
I
right?
think we
Because
I think we just stay down the finance lane. We'll be all right.
yeah, I wonder how many of our YouTube followers are watching these because they want to look like the two of us.
We're not going to pull anybody on that because I'm afraid of what those results might look like.
In
But
fact, you know what? I think what we need to do when our intern Andrew edits this video and posts it to YouTube, Andrew, we're just letting you know, please disable comments. I don't want to hear from anyone on this. We're
yeah,
not we're like normally everyone says, hey, put your opinion in the comments. No, don't. No one comment. No one comment on this video. I'm begging all of you, just don't like, don't comment, don't click notifications, don't
please,
subscribe. You know what? Just
please.
yeah, log off right now if you want. Just whatever you do, don't respond to the question of whether people want to style themselves after the two of us.
Well, if you're listening to this and you're wondering where you are, you probably are in the right spot. So, this is Deep Knowledge Investing's Five Things, getting off on a little bit of a tangent. But Gary, yeah, exciting stuff to talk about today. We're going to talk Janet Yellen, what she had to say recently. Line item for me is actually a new DKI stock pick, Shockwave Medical. So we're going to jump a bit into that. We'll talk uranium, some Bitcoin, and also used cars. So definitely has been a topic of conversation over the last couple of years, prices on those and where that's heading and what that direction looks like. So you ready to rock and roll?
Let's go.
All righty. Five things. Point number one, Janet Yellen accidentally destroys the narrative on inflation. Oh no.
Yes. So Janet Yellen is currently our Treasury Secretary. Before that, she was the chairperson of the Federal Reserve, where she famously said that her biggest regret as chair of the Federal Reserve was not creating more inflation. So I know we were joking before, no one comment, but let me ask everyone who's listening to this. Here's my question for you. We've had lots of inflation the last couple of years. Are you enjoying that? Has that made your life better? Are you happier? Do you feel like we have a better economy? Are your finances at home better because we have lots of inflation? Because that's what this person wanted for us. Her biggest regret was not creating more inflation. She wanted this. And so, just a reminder, the inflation that we have right now, this was not an accident. This was planned by people and was done intentionally. So this week, Yellen, who has been a horrendous Treasury Secretary and was a horrendous chair of the Federal Reserve, came out and said in public, we don't have to get the prices down because wages are going up. And so to me, like, is the most remarkable thing about this the fact that Yellen is either insensitive and economically illiterate or that she said this in public, right?
Right.
So in terms of like insensitive and economically illiterate, yeah, great. So people got raises and they have to pay more for things. But for most people, yeah, a lot of people have gotten raises and they're making more money, but their purchasing power has gone down by more. And
Right.
so you could have gotten a raise, but be worse off. Your higher salary may be buying you less than your lower salary did a couple of years ago. Also, what about people, retirees, people living on a fixed income, right? I mean, those people are feeling a ton of pain right now because everything's gotten a lot more expensive. The other thing, Robb, that I think is really important on this is our government has been trying to tell us, our Treasury Department, the White House, the Federal Reserve, they keep making excuses. They've told us incorrectly that inflation was due to supply chain problems or it was due to Vladimir Putin. Okay. Well, great. Well, Putin invaded Ukraine at this point almost 2 years ago, and oil prices have come down, and we still have inflation. But this is the key point here. If the issue had been supply chain, right, during COVID, once that normalized and the price for shipping came down and people were able to get parts, then prices would have come down. But they didn't go down. Prices have continued to rise. They've just continued to rise more slowly than before. And one of the things we've talked about a lot on this channel is the difference between disinflation and deflation. Deflation is a reduction in prices. And if the issue had been supply chain, then when that normalized, we would have seen deflation, a reduction in prices. But that's not what happened, right? What we've gotten is disinflation, which is a continuing increase in prices. It's just prices have gone up at a slower rate than they did before. So what has really caused all this inflation was a massive increase in the money supply, right? Our government handed out stimmies to everyone. And if you got a check, great. Yeah, it was really fun to get a $1,000 check, a $1,600 check, an $800 check in the mail. Great, free money. Well, guess what? You're all paying for your stimmies right now through higher prices. And for the vast majority of families, your expenses, your annual expenses have gone up by more than the amount of money that you were given. Yellen is wrong on this. She is insensitive on this. And to say we don't need lower prices because people are making more money is really, it's saying the quiet part out loud. And it's basically a tacit admission that the cause of inflation, the things that the Federal Reserve, the Treasury, and the White House are blaming for inflation are not the real issue.
What a motivation, right? I mean, what would even motivate her, or what would even be the reason to come out and say something so insensitive, one for sure, but just blatantly false and wrong in every which way? It makes very little sense to me, especially when it's immediate. Someone like you calls her out, right, on what it is she's saying being not true.
Yeah, so the thing with Yellen, with all these people, it's very important to remember, is they are political operators. And sure, they'll stand in front of the cameras and say, "Oh no, no, my job is finance. The goal of this agency is to do a certain thing. We focus on that.
Mhm.
We don't focus on politics." That is a lie.
Yeah,
That's a lie. These people are all political operators. And so, think about it. We're now we're not going into an election year. We are in an
right.
election year. She wants to protect the White House. And so the more people focus on the increase in the cost of living, the more people focus on inflation, the worse that's going to be for the reelection efforts of the White House, the worse that's going to be for the people who are in power to try to keep them in power. So what they're trying to do right now is say, listen, nothing happened, everything's fine, but even if something did happen, it's not really our fault. Like basically they went from saying the thing that's happened isn't our fault, right? We've had inflation, but it's not our fault. It's not our spending. It's not our policies. It's really just been, supply chain, which we couldn't control. They could have controlled that, but they didn't. It's Vladimir Putin. We couldn't control that. They could have controlled that. They didn't, right?
Mhm.
But they basically went from saying there's a problem, but it's not our fault to saying, oh, well, there's really no problem. Everything's fine. I
Right.
mean, this is basically, Rob, what this is. It's public flailing, trying to
Mm.
change the narrative
Yeah.
as, the even though we're technically early in the primary season, it does seem like the fields on both sides are very
No doubt.
narrowed, right? And the path to a nomination as it is today for, anyone not named Biden or Trump is pretty hard. President Trump is going to be very hard to knock out of that slot. I've seen a ton of rumors over the last week that that Biden is going to step aside. I think he didn't help himself last week when when an investigation came out and people said, okay, look, he broke the law, but we don't want to accuse him of anything because they basically said he's a senile old man who's going to say, I don't remember anything. And he's going to come off as sympathetic. And when people said, okay, wait a minute, we're a little concerned about you saying you're too senile to defend your actions, but how are you president of the United States? He then came out to defend himself and then immediately mixed up the president of Mexico with the president of Egypt and those borders. And he didn't help himself
Right.
on that. So, there are rumors because of that he's going to step aside. But if he doesn't step aside, it will almost certainly be the Democratic nominee. And so, as each party coalesces around
Yep.
their chosen person, whether people like those choices or not, this is the direction we're going. Um, this is where we are. And so we're kind of in the political narrative part of the drama here,
Right.
where they're just going to come out. They've literally gone from saying the problem is not our fault to, well, there's really no problem.
Right.
And so that's, you know, when you're saying it doesn't make sense, no, what she's doing makes sense. It's just, if you understand finance, you understand what she's doing and that it's dishonest. And again, she said the quiet part out loud. Like, basically, she's putting the blame for the situation on herself, on Congress, and on the White House. She's, just they're in a tough spot in terms of trying to convince people that the higher cost of living is not due to their policies.
Right. Very interesting. Lots to look forward to in 24.
Yeah, wait, let me just put
Yeah, go ahead.
one other key point on this is, let's imagine in November, hypothetically, the Republicans have a clean sweep, right? So President Trump is back in office, and we end up with, by we, I mean the United States, ends up with Republican control of Congress and the Senate. But if that happens, because I don't want people to think I'm just blaming the Democrats for this. If that happens, if there's a Republican sweep in November, you should expect continued inflation because the Republicans are big spenders as well. They're not
Mhm.
going to cut spending. And, people love to call President Trump a far right extremist, but he was a huge spender.
Yeah.
He spent enormous amounts. And even when he had a Republican Congress and a Republican Senate, they didn't cut spending then. And
Right.
and they won't if given the choice. So, you know, nobody should think that I am solely blaming the Democratic Party for inflation and massive spending. On this particular issue, I think they're worse than the Republicans, but do not think that, if the country gives control back to the Republican Party, that we're going to have a reduction in spending and go back to, have some sort of deflation. It's not going to happen. Inflation and money printing will continue regardless of who's in power in Washington.
Great points. Thanks for clearing that up, Gary. And one thing I should have mentioned too, I think I left out the title of this week's
Yeah.
5 things, silly people saying silly things issue. So we'll keep that thread moving forward. So point number 2, going to shift gears to Bitcoin, which over the last few days has been on an absolute tear. I believe it actually broke 50,000 earlier today.
Yeah.
Point number 2, Bitcoin recovers post ETF approval dip. Timeline gets quiet.
Yeah. So you're right. Again, we have silly people saying silly things. So, Rob, let's go back a month, because it was just over a month ago that the SEC, the Securities and Exchange Commission, approved 11 Bitcoin ETFs. That stands for exchange traded funds. For people who are new to this channel, it is simply a way for people who have traditional brokerage accounts to get exposure to Bitcoin. Now, if you're listening to this and you want to have exposure to Bitcoin, the best way to do it is to buy it directly into self-custody. And if you're interested, reach out. Deep Knowledge Investing has published a self-custody guide. It is super easy to follow. We have demystified all of it and made it, really simple for people. And it can be, but for some people, they don't want to learn that. They don't want to self-custody. They don't want to have that risk, or for, maybe for regulatory reasons, they have to have their assets all in a traditional brokerage account. And these 11 ETFs make it possible for those people to buy exposure to Bitcoin. And so one of the things we've talked about is, going into these approvals, there was a huge debate. Now, there were Bitcoin bulls like myself who said, wait a minute, issuance right now is about 900 coins a day. That's going to be cut in half in the next couple of months. And when you have the ability for all these new people to buy Bitcoin, but not have much of an increase in supply, the thing that will adjust will be the price. And we saw, Bitcoin ran up huge into those announcements. And right about the time when the SEC approved it, the Bitcoin was trading around $44,000, $45,000. It briefly touched, 47 right after the approval. But there also were a lot of people who were saying that it's all priced in and that as soon as the ETFs are approved, Bitcoin is going to fall off a cliff. It's going to implode. The price is going to be, it's going to crater. And a lot of them said, it'll find its true value, which they believe to be zero. Okay. Great. Let's see. And, one of the things we talked about was Bitcoin went, over the following week from about 44, 45,000 down to about 40,000. It cracked 40,000, to the downside, but it was down a little over 10% in that time. And what we saw were the Bitcoin bears, the people who were anti-Bitcoin, coming out and crowing. They're saying, oh, yeah, see, we told you it's collapsing. The price is going down. It's going to zero. All you bulls were wrong. Okay, great. Well, here's what's happened over the last couple of weeks. Bitcoin has gone from around that 40,000 level to, Rob, you're right. Today, it crossed 50,000. So it's up from last year. It's up from a couple months ago. It's up from last month. It's up 25% in the last week or two. Right. And so in my opinion, right, this is just me talking. I think it's silly to have a short-term price target on Bitcoin. I think if you own it, the reason to own it is because one of the things we've talked about is fiat issuance, right? The US government is just printing more and more dollars, and that is reducing the purchasing power of your dollars. And so I don't know where Bitcoin's going to be a year from now or 5 years from now, but what I do know is that the purchasing power of the dollar is going to be down a year from now, 5 years from now, 10 years from now. Inflation always goes in one direction. And so my thesis on Bitcoin is long term. I want to own this for years and years while the purchasing power of the dollar declines. And this is a great deflationary asset. This is a great way to insure yourself against loss of purchasing power in the dollar. And that's my thesis. But okay, fine. But for all the people who were so negative and crowing, oh, see, we told you Bitcoin's a zero, it's collapsing. They were doing that based on the price action over a couple of days to a couple of weeks. Okay. But what I've noticed is that my Twitter timeline, my X timeline, has gotten very, very quiet. And none of those people are issuing mea culpas. And one of the things we do at Deep Knowledge Investing, we have not gotten a lot of stock picks wrong, but when we do, and when we lose money, and when we take that loss, I always issue the mea culpa. I explain to people, this is what I got wrong. This is what I thought would happen. This is what happened instead, right? We own the mistake. We take responsibility for it. And we acknowledge, okay, we got this wrong. This is why we got it wrong. But I'm noticing that these Bitcoin bears are not doing the same. And I would love to see them have the same humility, the humility to match their hubris, right? Because they were telling all of us, you're wrong, you're wrong, you're wrong. But when the dollar price of Bitcoin moves 25% in a couple of weeks, and it's well above that pre-SEC approval level, why are these people so quiet now? Why are they not out saying, okay, yeah, we got it wrong? Because if you're going to claim you were right after 2 days or 2 weeks, well, great. Now it's a month later. So on the basis of the last 2 weeks trading action, admit you were wrong, right? Come out, whatever standard you're setting to declare you were right, that's a standard you use to admit you were wrong.
Don't hold your breath, Gary, waiting for those mea culpas. I think that's probably a study into just human nature in general about why people don't say things when they get things wrong.
Look, I think you're right, Rob, but I will tell you, after more than 30 years in this business, look, it hurts to be wrong. And it's never fun to admit it. It's never fun to admit it publicly, to stand in front of people who have trusted you with their money, with their assets, and say, we lost money on this. This is what I got wrong. It's very hard to do. But I will tell you, in the money management business, the penalty for not doing that, the penalty for that hubris of never admitting you're wrong, is you end up taking massive losses. And
Right.
nobody's going to be right all the time. But, you know, if you're right most of the time and you don't get crushed in your losers, you can do really well. And a big part of being great in this business is being willing to acknowledge your errors. Because if you don't, you convince yourself that everything's fine and you lose more and more and more money. And, you know, I mean, I think it would be interesting to find out if any of these anti-Bitcoin people had the courage to short Bitcoin.
Right.
Do they have
Right.
short exposure on this? I'd love to know that, because I'm taking the other side of that trade right now. But you know, are they just talking loudly in public, or do they have capital up on that bet? And you know, one of the ways that we differentiate ourselves here at Deep Knowledge Investing is every stock pick I have, every time I tell you guys, you know, I like this position, I own this, I own it. My capital is up. If I'm wrong, I'm going to lose money, and that's not fun. You know, so I'd love to know, do they have money up on this opinion, or are they just talking in public when they think they're right and quiet in public when they think they're wrong? And you know, I don't think any of that leads to reasoned discourse, or you know, it's I don't find it persuasive.
Sure, sure. Yeah, probably have a lot of handfuls of everything you just mentioned and in between as well. But good segue into point number three here. This is really exciting anytime DKI does come out with new research report. But point number three of this week's five things, DKI releases their report on Shockwave Medical, trades under the ticker SWAV.
That's right. Yeah. So first of all, I'm going to give people two disclaimers here. One, uh, on the finance end of things, please do your own work. You know, if you're not a Deep Knowledge Investing subscriber, you know, even if you are, you have to be responsible for your own investment decisions. I'm telling you that I own this in my account, and I'm about to tell you why. The other thing is, because we're talking about a medical device company and it's for cardiac procedures, and we'll explain what they do. I just want to emphasize, this is not medical advice. I am not a physician. I'm not qualified to provide medical advice. While Deep Knowledge Investing does have a phenomenal cardiologist on our board of advisors, he is not your doctor, and my firm does not provide medical advice. If you are having a medical problem, a heart problem, if you require a stent being put in, we strongly suggest that you go see your doctor, go see a doctor. This is not medical advice, and my firm does not provide medical advice, and I'm not a doctor. So there we go. Um, so what happens with a lot of people, this is very common, arteries that go to the heart, the tubes that carry blood to the heart, can become clogged. And so a number of years ago, um, people invented something called a stent. It's like a little wire mesh thing that you slide into the part of the artery that's blocked, and you expand it. And as you expand it, it opens up room to increase blood flow. And these are very common procedures now. And, you know, while any cardiac procedure can be dangerous, it's now a pretty safe procedure. Um, but there's a problem. In somewhere between 10 and 25% of cases, there's excessive calcification. And that's just a fancy way of saying there's hard plaque in that area that makes it hard to push the stent through, even in its small form, before you expand it. Now, for years, Rob, the standard of care was something called a rotablator. Now, imagine like a tiny drill that spins at incredible speed. And so the interventional cardiologist, your surgeon, would put this drill through the artery and use it to drill through the plaque. There are two problems with that. One, the main one, is you run the risk of perforating the artery. That's a fancy way of saying the drill could go through the artery and now you have internal bleeding. In a situation like that, people can die on the operating table in minutes, right?
Mhm.
So a rotablator, it's not highly dangerous, but if something goes wrong, it goes really wrong. The other problem is the rotablator is good for creating a path through the center of the artery, but it's hard to do much for the plaque that's on the wall of the artery. And the issue with that is it can make the wall of the artery brittle and lead to future complications. Now, what Shockwave has done is they have combined a device that can emit electrical pulses that break up um, this plaque, the calcification, with the stent. And so with Shockwave, what they do, the surgeon will put in the device, it will emit electrical pulses that will break up not just the plaque in the middle of the artery, but the plaque that's on the artery wall. And then they place the stent and expand it. And in a situation like that, the risk of negative medical complications is very low, much lower than it would be for a rotablator. And because they've cleared the plaque from the artery wall, that stent is going to be a better long-term medical placement than it would be under other circumstances. Uh, so basically, what we have here is a fast-growing medical device company where the product is phenomenal. We've spoken with multiple cardiologists, interventional cardiologists. This is the best standard of care for that 10 to 25% of cases that are complicated right now. And I've spoken with the company, I've spoken with cardiologists. They have a 2 to 4 year lead on the competition. So the end result here is we think Shockwave is going to be bought by a competitor. They were in discussions with Boston Scientific last year. Johnson & Johnson has been interested. And there are one or two other companies that have been tracking Shockwave and are interested and could be good competitors because acquirers, because there's no one that has competing product. The other key thing that I would say is the news here from our point of view is we've just released the report on it, made it available to the public. But Deep Knowledge Investing subscribers were told about this idea in December. We started buying the stock at 191, and they had plenty of opportunity to buy the stock below 200, in the low 190s at 190, 191. The stock closed a day ago at $235. I actually think that's where it closed today. So, DKI subscribers have made enough money on this to more than pay for the cost of their subscription. For people who are listening to this, I haven't sold a single share myself. It's because I think the company gets acquired for more than $300 by a competitor. And so, I don't think people have missed it. I think, DKI subscribers have done really well in this. But, if you're listening to this and you're interested and you want to learn more about it, reach out, and we're happy. Like this report we've now put in public. So we're happy to share that with you.
Yeah, great point, Gary, regarding the report. If you are interested, head to investor.deepknowledgeinvesting.com/SWAV, that ticker there. You'll be able to enter your email, get that report directly delivered to your inbox. And as Gary has mentioned, yeah, definitely a great movement on that ticker since December. Moving point 4, we talk uranium here on this show quite often. Here we have this again. Cameco? I should have asked you first, Gary. Is that the
So
correct?
I think it's pronounced Cameco.
Okay, I figured it was probably going to be one of those unique ones. So,
Yeah, some people call it Camco. But I believe the proper pronunciation is Cameco. And if I'm wrong, I'm sure someone will correct me in the
leave
comments.
a comment. We're really opening ourselves up to quite a bit of scrutiny after this.
But in fairness, Rob, this is the silly people saying silly things issue. We
That's
can
right.
we can do that this week, but yeah.
I can include myself in that underneath that umbrella. So, anyways, point number 4, we'll use ticker CCJ. Light on Production has to buy spot uranium, and they're one of the world's largest uranium producers.
Yeah, so let's talk about uranium for a minute. It's been a big subject at Deep Knowledge Investing. We started buying uranium through a particular ETF a little over a year ago. That, for me personally, has been a massive position. I bought a huge position, and the price of uranium is more than doubled in this time. The value of the ETF that we own is more than doubled in this time. So I've gone from having a huge position to more than twice a huge position in this. We're sitting on huge profits in the name. And again, like Shockwave, I haven't sold any of that. And the reason for that is because we are going to be looking in the next year at all-time highs in worldwide nuclear energy production. the new Gen 4 plants can be smaller. They don't melt down. They not only do they not produce nuclear waste, they actually use nuclear waste. And, we've pointed this out before, for the environmentalists listening to this, if what you want is reliable baseload generation without carbon emissions, nuclear is the option. This is the way to go, and uranium is the fuel for it. Um, and again, for the environmentalists, if you want people, if you want the electrification of everything, right? You want people using electric for heat, electric for their stoves, and electric for their vehicles. This is what you need to do to have a reliable grid. You can't do all of this on solar and wind. That's just not reliable baseload generation. You can use that for peakers at times. So what we're seeing is a lot of nuclear plants being built, older plants being, instead of being decommissioned, the useful life is being expanded. And so we have this increase in nuclear plant use or energy demand. And it takes years and years to bring on supply, to get things permitted and to build new mining capacity. And so right now, every year, approximately 20% of the world's uranium storage is used up for existing, basically it's for existing supply. And so every year we're working down our stockpiles by about 20%. At this point, there's 4, maybe 5 years of supply left. And so what's going to have to happen is either a giant increase in the price of uranium, or alternatively, people are going to have to mine more. But as we pointed out, it's going to take a while to get that mining capacity online. So that's Deep Knowledge Investing's positive thesis on uranium. Now, what happened last week is Cameco is one of the world's largest uranium producers. They mine. These are the guys you look at if you want to know what's happening in the uranium market. Now, they had told people, they had given people a projection for how much uranium they were going to produce. And then they lowered that projection, and then they fell short of it. And so if you fall short of your production goals, Rob, where do you go? You go to the spot market, right?
Yeah.
And so I'm making up numbers. These aren't the exact numbers, but let's imagine you've sold supply contracts for 20 million tons of uranium and you produce 17.5 million tons. Well, guess what you have to do? You have to go in the market and buy another 2-3 million tons of uranium. And Cameco came out and they said, we're looking at increasing production over the next few years. We're thinking about it. We're examining it, but they haven't really done it. And they gave you their projections for 2024. And guess what they told you? They told you that they're going to produce less uranium than they have supply contracts for. And so it's going to happen again. You have one of the world's largest uranium producers that last year had to go into the spot market and buy because they don't produce enough. And they have these long-term supply contracts. The same thing is going to happen again this year. And so that is going to put more pressure on the price of uranium. That's upwards pressure, right? The only way this pressure is going to be alleviated is we have a giant worldwide recession and energy demand falls off a cliff, which maybe it could happen, but it's pretty hard to shut down a nuclear plant. Or more likely, at some point, people are going to say we need to produce more uranium. But again, those projects take years to come on. Now, here's where we think the market got it wrong. When Cameco announced earnings, the price of uranium fell that day. It went down substantially. And, look, the market often, the expression, we've talked about this before, is buy the rumor, sell the news, right? So we weren't the only ones who knew that uranium supply and demand is out of line. And there might have been people saying, okay, great, Cameco, they can't produce enough, or they're choosing not to produce enough. They're going to go into the spot market. And that's fine, but that news is out. And so, they might have been selling, and, we just view these things as buying opportunities because long term, the only thing that's going to happen is the existing stockpiles keep getting run down and down and down. And so again, we want to own uranium into that. I think the market reaction on this one wasn't the right one. And needless to say, we did not sell a single share of the ETF that we use to get uranium exposure.
Was it a misunderstanding of Cameco coming out and saying that there's not the demand for the increased level of supply, that they didn't meet with the spot purchases? Or so was that just a misunderstanding in the market, seeing that as a decreased demand side issue?
It's hard to say. Frequently when things happen in the market, you can come up with all kinds of reasons. Sometimes people do misunderstand things. In general, it's dangerous to say, everyone else is dumb, everyone else is wrong, no one
Sure.
else understands. Um, it could have happened. In this case, without clarity, I'm reluctant to make any kind of accusation about anyone else. I think the market was wrong on it. In terms of, individual portfolio managers, I don't know. Part of it also just might have been the short-term trading dynamics. The price of uranium has gone parabolic. I'm looking at the chart right now. If we go back to as recently as last May or June,
Yeah, May.
yeah,
May.
so uranium was at basically $50.
Right around there. Yeah, hovered
Yeah,
for all of
and
beginning of
yeah,
2023.
exactly. And now it's over 100. So, I think what's happened is the price of uranium has more than doubled in less than a year,
Sure.
in about 3/4 of a year. Um, and so, again, it may just be some short-term trading dynamics, some of that again, buy the rumor, sell the news kind of thing. Um, if you're a day trader, yeah, these things matter. But my thesis on uranium, our thesis on uranium, it's a long-term thesis. I plan to own this on a multi-year time frame. So, we just as long as we understand what happened, and when we looked at the Cameco earnings and more specifically their production versus their supply contracts, um, it just seems to me like that was confirmation that our long-term thesis on this continues to be right. And we just use these moments as an opportunity to buy more of the things that we like.
Definitely. Wrapping up for this week's five things, we're moving into used car discussion. Point number five of DKI's five things: used car pricing dropping. Will that affect the CPI?
Yeah. So the index that we tend to look at here is the Manheim Used Vehicle Value Index. Manheim is, in my opinion, really the best aggregate determinant of the demand and pricing for used vehicles because they track everything. So like if you're a car collector, and there's a particular loved vehicle that you have your eye on, then you'll know what's going on with that car. But Manheim is for the general the general index. And if we go back to just before COVID, the Manheim index was hanging out around 150, and it ran up during the COVID lockdowns to a little over 250. That's an increase of more than 60%. So if you needed to buy a car during those years, you were looking at prices in a year or two that were up more than 60%. That is crippling for a lot of families, right? A lot of people, they simply can't do it. And so it created all kinds of problems. And the reason for a lot of it, this actually was a supply chain issue. What happened was a lot of chip production was just difficult to get a hold of computer chips. And cars today use an enormous number of computer chips. And so what automakers were doing was they were finishing tens of thousands of cars. They had everything done but the computer chips, right? So the cars were like 99% done, but you can't sell them without the brains of the vehicle in there. And they were just parking them on lots and having them sit there. And because you couldn't get new cars into the system, everybody who needed a car was trying to buy used cars. Well, so here's what's happened. That Manheim index has declined from over 250. It's now down to right around 200. And so about half of the increase during the COVID years has been worked off. And that's, used vehicle prices are still high, and they're still very high compared to where we were, just 3 or 4 years ago. But compared to where we were a year or two ago, they've come down a lot. And so the question is this going to affect the CPI? Can it matter that much? And to make things, even worse, is used cars and trucks are 2.5% of the CPI. That's the consumer price index. So, it's really easy to say, does this matter, right? If it's only 2.5% of the index, right? Who cares, right? Well, it actually does matter. And here's why. What we've had in the last year is about a reduction in the index of about 9% for a year ago. Let's just call it, 10% for rounding at 2.5% of the index. Wait a minute. That's more than 0.2%. And, one of the things we've seen, and we've talked about this, is when the CPI is announced, if they make or miss the expectation by 0.1%, the market trades off of
Right.
that. The market views a 0.1% change in the consumer price index as significant enough that the S&P 500, the NASDAQ in particular, are going to move on that. The Federal Reserve is looking at that. People base their predictions of future Federal Reserve rate hikes, or in this case, rate decreases, based on the CPI. So if the Manheim index, if a reduction in the price of used vehicles moves the CPI by 2%, does that matter? Yeah, it actually does. And it's also a huge relief for people who are looking to buy a used car.
No doubt. Gary, thanks so much, as always, for your time this week on the five things. This is our weekly show in which we touch on hot button topics in the market, things having to do with DKI investments as well, and everything in between. Thanks, everyone, again for watching. Remember, head to deepknowledgeinvesting.com in order to grab a free subscription or also consideration for a premium subscription. As Gary mentioned, just looking at Shockwave Medical, like we talked about earlier, tons of gains and opportunities that were created by DKI investors. We're really trying to provide as much value as we can for our premium subscribers in those subscriptions, and would love for you all to give us a try. And Gary, anything else that you might have to say to close out on the points for this week?
Yeah, just two things, Rob. One is it is our goal, and we've succeeded in this, for our subscribers to make more money off of our stock picks than they pay in subscription fees. And I think we've done that certainly with Shockwave. We had people buying huge positions in GBTC, which was the early
Yeah.
version of the Bitcoin ETF. It got changed from a trust to an ETF, but we were buying that a year and a half ago at 14 and a half. We were buying it last spring at 18. It's around 44 right now. And so, I think we've succeeded in that. Our subscribers are making more money from our picks and they're paying in subscription fees. And I'm excited about that. That's why I do this every day, right? To work with people to help them do better. And that's a great feeling. The other thing is, for everyone listening to this, thank you so much for your time. We know it's valuable. Really appreciate you watching. For future programming, I will point out that next week's five things, we're going to be talking about the CPI, the Consumer Price Index. That's going to be announced this week. So we'll have analysis of that. That's going to be the big news. And then the other thing is, tomorrow, Tuesday the 13th at 11 a.m. Eastern Time, New York time, I'm going to be talking with Tracy Schuart on energy. We'll be talking about oil and gas, more on uranium, on the pipelines, and on the various geopolitical events that are causing changes in the price of uranium. We'll be live streaming that on Twitter Spaces and LinkedIn Live at 11 o'clock. I'll be recording that, and we'll get that video up here on YouTube as soon as possible. And so if any of you are interested in energy, feel free to tune in at 11 o'clock tomorrow, or just check this channel in a day or two, and we'll have the video of me talking with Tracy, our kind energy expert, who's going to be my guest. For you guys, we'll have that up in the next day or so.
Yep, really exciting stuff coming. And yeah, be sure to subscribe as well. You'll get notifications on any new webinars, speaking engagements, reports, etc. Gary, as always, been a pleasure speaking with you for the last however many minutes, half hour, hour, and look forward to speaking with you next week.
All right. Thanks a lot, Rob. And everyone, thanks for taking the time to watch. We appreciate you.
Thanks, everyone.